Welcome to Financial Insights in Minutes, where we deliver time-saving summaries of the day's top financial videos.
Today, we unpack whether the economy is truly in trouble based on expert opinions.
Stick around as we dive into recession fears, labor market trends, and market predictions.
Let's break down what each expert has to say on today's pressing topics.
First, Mark Zandi of Moody's tackles whether we're truly in a recession. Next, Jeff Snider confronts the unsettling reality of an unemployment recession. Craig Hemke breaks down the impact of panic selling on global markets. Simon Hunt predicts a staggering 40% drop in the equity markets. Lastly, Mike from Mott Capital discusses the effects of the yen carry trade unwind. Welcome back to David Lin's channel. Today's topic dives into a burning question. Are we in a recession or just experiencing some economic turbulence? Joining us is the insightful Mark Zandi, chief economist at Moody's Analytics.
Mark's expertise in economic forecasting and analysis gives him a clear lens to navigate this complexity. Let's dive right in and get straight to the facts.
So what's the crux of Mark Zandi's discussion? Are we really in a recession, as some say?
Mark argues that although unemployment has ticked up to 4.3%, this doesn't indicate a recession. The rise is largely due to a boost in labor supply rather than falling employment levels.
Let's unpack those key points. First up, what's the deal with the unemployment rate?
The unemployment rate has indeed hit 4.3%, but that's largely attributed to an increase in labor supply, thanks to an influx of immigrant workers looking for jobs.
Interesting. What about job creation trends? Are we seeing a slowdown?
Mark notes that while job creation is moderating, we're still adding about 150,000 jobs monthly, contrary to recession signals.
What role is the Fed playing in this economic dance?
The Fed's current high interest rate strategy is under scrutiny. Mark suggests they should reduce rates by 50 basis points to foster growth.
Looking ahead, what are some of Mark's predictions for the economy?
Mark expects economic growth to continue, but emphasized the importance of policy adjustments to support this trajectory.
And what about inflation? Any projections there?
Economic policies, especially under potential political shifts, may lead inflation to rise again, which investors should monitor closely.
To wrap it all up, what are the main takeaways?
Mark emphasizes that we're not in a recession despite rising unemployment. He calls for the Fed to consider rate cuts and urges policymakers to address economic concerns directly.
Welcome to Eurodollar University. Today's hot topic is the unemployment recession that's gripping the job market. Joining us is the insightful Jeff Snider, a macros analyst with a sharp eye on economic trends and monetary policy.
That's right. Jeff dives into the intricate details of our current job situation and the broader implications for the economy. Buckle up, it's about to get informative.
What's the main message from Jeff's analysis? Why should people pay attention?
The core thesis is simple. We are witnessing an unemployment recession. The unemployment rate has jumped to 4.3%, and this trend suggests a full economic recession is imminent.
Let's break down those key points, starting with the job market stats. What are the numbers telling us?
As stated, the unemployment rate has surged to 4.3%. Meanwhile, the underemployment rate has also risen to 7.8%. indicating significant weakness in the job market.
And jobless claims are flashing warning signs too. What's going on there?
Absolutely. There's been a notable surge in both initial and continued jobless claims, which further supports the notion that the labor market is in distress.
Consumer sentiment plays a big role as well. What are we seeing there?
Consumers are feeling the pinch. After taking on significant debt, they're now struggling to keep up with rising expenses, leading to decreased spending and economic activity.
So, what does the future look like in terms of monetary policy?
It's expected we'll see a series of rate cuts from the Fed. With the economy in a downturn, it'll be crucial for them to respond adequately.
What other predictions are on the table?
Labor market conditions are expected to worsen as signals of recession continue to emerge. This isn't just a temporary hiccup, it's a looming crisis.
Wrapping it up, what are the key takeaways from this discussion?
The data is clear. The job market is entrenched in recession. Urgent action is needed as policymakers face tough decisions on how to navigate this crisis.
What should people keep an eye on regarding employment rates?
Pay attention to rising unemployment and underemployment rates. They reveal deeper economic troubles than many may realize.
Welcome to the Technical Traders. It's time to navigate the choppy waters of the financial markets. Today, we're diving into a deep analysis of the recent global panic selling.
You said it! Craig Hemke breaks down some eye-popping market movements and shares strategies for traders to handle this volatility. Hold on to your hats.
So what's the crux of Craig's message amid all this chaos?
The main thesis here is that the panic selling, driven partly by Warren Buffett's massive Apple position cut, could indicate a market washout, allowing for a potential rebound after this chaos.
Let's break this down. How are the indices faring?
It's wild. The Nasdaq has plunged almost 6%, while the S&P 500 fell 4%, and fear is palpable, with the VIX spiking 145%.
And what about the economic indicators pointing to the selling frenzy?
Berkshire Hathaway has a whopping $300 billion in cash now. Investors are flocking to bonds as a defensive move.
So, what's the outlook moving forward?
Craig suggests that panic selling often foreshadows a short-term bottom, so we may see a bounce soon. Markets have a way of surprising us.
What predictions does Craig lay out for the coming days?
He anticipates that as panic subsides, we could see a market bounce. Historically, these cleanses often allow for recovery.
Sounds intense. Any warnings about trends?
Yes. Continued high-volume selling by large institutions could signal a prolonged downtrend, but the bounce may help.
So, what are the big takeaways?
Navigating these turbulent waters requires caution. The potential for recovery exists, but bear watching for distribution selling signs.
What parting advice does Craig have for traders?
Stay flexible and ready to pivot. It's no time to hold tight when markets are in flux. Act wisely.
Welcome to WT Finance. Today's conversation dives into a looming market disaster, a potential 40% equity market crash. With insights from financial analyst Simon Hunt, who's back with us after some tech hiccups, get ready for some hard-hitting economic truths.
Exciting topic. Simon has a wealth of experience analyzing economic trends, so he's perfectly poised to give us the juicy details on this impending crisis. Buckle up, everyone.
What's the main thesis here? What are we bracing for?
Simon predicts we're currently in the throes of a recession that could trigger a shocking 40% drop in global equity markets. This isn't just market noise. It's a full-on economic storm brewing.
All right, let's delve into those key points. What does Simon say about the economic indicators?
Firstly, Simon warns that the recent GDP figures are likely inflated. The real situation on the ground is a lot direr due to inflation crippling consumer spending.
What about those market predictions?
He's forecasting a significant 40% drop in the equity markets, expected somewhere around early next year. But don't be fooled, there might still be minor market highs before everything plummets.
And let's touch on geopolitical risks. What's brewing there?
Simon points out that tensions in the Middle East and Europe are at a boiling point. He fears that a significant cyber attack could also create massive disruptions in the market.
And what's the monetary policy angle in this discussion?
Expect massive monetary and fiscal printing early next year. This could reignite inflation, potentially hitting double digits and further destabilizing the economy.
What are some of Simon's major predictions about the market?
He predicts the S&P could plummet to around 3,000, ushering in a highly inflationary phase lasting up to 24 months.
Simon seems pretty concerned. What's the geopolitical situation slotted to manifest?
Another stark prediction. He warns of the risk of an open conflict between NATO and Russia, potentially this September. While markets might show a little upward movement initially, the overall risks outweigh the rewards.
To wrap up, what are the takeaways from Simon's insights?
The key point is to prepare for a significant market crash and rising inflation. Simon drives home the importance of being cautious and possibly taking risks off the table as we navigate these turbulent waters.
Any final words of wisdom from Simon?
He suggests that it may be prudent to take risks off the table for now, keeping a keen eye on any shifts in the economic tide ahead.
Welcome to Mott Capital's Market Chronicles. Time to navigate through the stormy seas of the stock market as we discuss the recent sell-off that's making waves. Today's guest is Mike, a seasoned investment analyst who knows the ins and outs of market trends.
Exactly. Mike has been analyzing the market currents for years, giving him a sharp eye for spotting opportunities and pitfalls. Buckle up, viewers. This is going to be a wild ride.
So what's the main thesis behind this market sell-off?
The core thesis is that the sell-off is primarily driven by the unwinding of the yen carry trade. With the Bank of Japan raising rates, this trade is now turning against investors, leading to significant ripples across global markets.
What are the key implications of the yen carry trade unwinding?
Well, the unwinding of yen short trades is causing panic and significant movement in global markets. For example, Japan's Nikkei index dropped over 12% recently. It's clear that this trade's unwind is not just a local issue.
And what's the deal with the S&P 500's valuation?
It's currently overvalued and trading down about 9.5% from its recent high. Experts predict further declines could see it dipping into the mid-4,000s, especially if key stocks like Nvidia falter.
What about the recession fears? How do they fit into this picture?
The current market trends definitely raise concerns about a recession. Regional banks typically struggle during such periods, and if the markets don't stabilize soon, we could see more trouble for these smaller entities.
What are some predictions for the coming weeks?
Expect continued volatility. As the yen carry trade adjusts, its influence on the market will play a huge role in determining future market movements.
Anything else we should watch for?
Watch for changes in liquidity. The excess liquidity from the yen carry trade may not return. This could result in a situation where buying the dip is no longer the effective strategy it once was.
To wrap things up, what are the main takeaways?
Vigilance is key. The yen carry trade's unwinding is a massive driver of current market conditions. Investors need to stay alert as market valuations adjust and the risk of recession looms.
And what can viewers do moving forward?
Stay informed and keep an eye on those global markets and regional banks. The landscape is changing swiftly, and strategic caution will be essential.
Today's discussion highlighted alarming trends across the economy, with Mark Zandi reassessing the recession claims, while Jeff Snider flagged serious warning signs.
Craig Hemke and Simon Hunt offered diverging predictions for market recovery and potential crashes. Security is key in these volatile times.
While there were differences in opinion, the need for caution and awareness in investing strategies was a shared conclusion. Thanks for watching Financial Insights in Minutes for August 5th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.